Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
Hi, my name is Aaron Ogti. I'm a financial advisor in the Bay Area. I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today. And thanks everybody for listening and watching.
Great to be here as well. So last time we talked about Kamala Harris's tax plan on unrealized capital gains. And we were kind of addressing that, and that's trying to address a symptom of wealth inequality, that there's this massive wealth disparities between the top small percentile and the smaller percentile, the bigger the inequality. And we're trying to, this plan is trying to address that specifically. Today, we want to get back to more of the root cause. So instead of looking at the symptoms, actually the underlying, I guess we can call it an illness of kind of one of the big problems in U.S. society when it comes to wealth inequality and kind of how we got here. And we have a disagreement, like, will this always be the case? So very roughly, I'm oversimplifying a great deal, but to set the premise, over the last couple generations, most of the top wealth in the country owned assets that increased at the level of equities. Basically, they owned a large percentage of the stocks. The stocks went up, we'll say 10% per year, as I'm given a long enough time frame, and they saw that 10% compounding on their net worth. On the bottom end of the spectrum, the wage earners saw their incomes only go up with inflation, which means on a real basis, real being the inflation or the economic term for inflation adjusted, on a real basis, wages have stayed flat, while all the equity owners have increased 7% per year over inflation or on a real basis, given a couple generations, and you start to see percentile differences in the thousands. So that's the main issue, that wages have stayed flat while capital and the ownership has increased exponentially. So Trishul and I were having kind of a conversation offline, like, are wages going to stay flat forever? Because this would be one of those underlying fundamental assumptions moving forward, that if wages stay flat ongoing, there's no particular reason why the equities are going to kind of only increase with inflation. There's a lot of strong economic reasons that stock ownership will continue to go at some level of inflation plus 7-ish%, something like that. But it will likely outpace inflation and have a positive real return over the next few generations. So unless wages are having real growth, so get that inflation adjusted growth, growing faster than inflation, the wealth inequality is going to continue to compound. So Trishul, I want you to lay the groundwork for your argument. If you want to go back prior than a couple generations, I'm okay with that. Like, kind of, why do you think wages will stay flat kind of indefinitely? So I you can maybe not that long, but you can set up however you want of why because it's a good assessment, like, why have wages been flat and why do you think that's going to continue?
Yeah, so there's a good amount to unpack there, but again, this is just one of those things where let's start peeling this onion and let's see where we end up. So I think, again, to begin, Aaron, you mentioned some of these numbers. I ChatGPT'd a few things, at the beginning of this just to set some precedents. I use a comparison between 1980 and 2023 in terms of household incomes by decile, to give us some understanding. Let me quickly share the screen here for the viewers, and I'll talk to it for the listeners. But essentially, you're going to hear essentially what Aaron, you spoke to in the introduction to this. Okay, is that kind of big enough?
Yes.
Okay, so you see in 1980, essentially you had a median household income of like 47,000, something like that. And again, these all adjusted to 2023 dollars.
Okay.
And in 2023, median household income inched upward just a little bit to like 55,000 a year, right?
Okay.
And that's essentially what is it? Over a 40-year period, that's like 0.5% growth, right? It's basically flat, meaning you're earning about the same as you would on a median household basis 43 years ago. And you can see by deciles, it's kind of true across the lower deciles. The lowest 10% of households had a $15,000 household income, and it's about $15,000 today. That's kind of true for the bottom 4 or 5 deciles. But then, as you climb up to the higher deciles, you see a divergence. I'll just jump straight to the top 10%. You had 130,000 in 1980. And that number's jumped to 200,000. So even after adjusting for inflation, the top 10% of households are earning much more. And, we touched upon this over the last, I think, 2 episodes, when we talked about the regressive nature of our current tax system and how using an unrealized capital gains tax can maybe mitigate some of these concerns. But essentially what we're seeing here is that if you're in the higher deciles, your income is increasing beyond the rate of inflation. And if you're in the lower deciles, it doesn't seem to be. And something we alluded to in the previous episode on unrealized capital gains is that if you are in the higher deciles, you're more likely to receive compensation from other sources beyond just wages. You're likely to receive compensation from investments, right? And capital gains, interest, dividends, things like that. And we noted, for example, that the tax rate,
some quick math for here, so give context, especially for the listeners. The median going from 47 to 55 was about 0.3% per year over 43 years. And the top decile going from 130 to 200 was 1% per year over 43 years. So roughly triple the growth.
Right, yeah. And you can see how that compounds. 0.3, 0.1, they both sound the same, but over decades, it's a pretty big deal.
Yeah.
And, what we noticed, or what we noted in the last episode, which also tagged on our previous episodes about this topic, is that higher income earners typically get their income from other sources besides a W-2 wage. They get their income from investments that typically grow more quickly, right? Aaron, as you had mentioned, the stock market has far outpaced inflation. If you graph CPI versus the stock market, you'll see one line go through the roof and the other just chug along slowly, making almost no progress. Should I pull that up, Aaron, or do you want to grab that?
I'm going to try to do the same thing, but go ahead. Keep
okay, so we'll share that in just a little bit, but that much is pretty patent. And then you compound that with the fact that as you get more income from investments, your tax rate ends up going down, meaning lower through various means that we've discussed. Then you have this double compounding effect of your income seems to be rising, your wealth seems to be increasing, and you seem to be paying lower taxes. Therefore, you can reinvest that income more sensibly. But if you're in the lower deciles, your expenses actually end up going up more than the incomes are increasing or not increasing, for that matter. For example, we noted, if you're in the lower deciles, you're likely spending more of your household income as a percentage basis on healthcare, on education, on housing, and all three of those areas have actually increased beyond the rate of inflation by a good amount, meaning you're spending far more of your household income on these three areas than you were in 1980.
Yeah.
And
So
what that
again, we have
effectively,
the in the real terms, the inflation adjusted terms, your income has stayed flat, but
yep,
your housing, healthcare, and education have all gone up.
yeah, are basically almost doubled in some cases, sometimes more, sometimes less. But imagine if those three used to account for 30% of your household income in 1980, and now they account for 60%, meaning you only have 40% of it, every little other thing in there, food, transportation, energy, all of that in that 40%. And imagine if that trend continues, right? You can't spend 120% of your household income on just these three things. So something kind of has to give, or income or wealth inequality is just going to spiral out of control. But essentially, the big point of this conversation is, if you're getting a wage as part of your income, meaning your sole source of income is a wage, that seems to have not increased over the last 43 years, meaning it's basically flat. And what I tried to allude to Aaron, I kind of said this off the cuff, but maybe I'm just double or tripling down on it, is the notion that I don't think it's ever going to increase again. Essentially, what the market has done is it has found a way to capture all of the productivity gains that come from paying somebody a wage and siphoning that into the growth in the valuation of the stock, and not really siphoning that amount back to the employees. And I feel like the market has gotten so good at that I don't see that trend ever changing again.
So, okay, I do have one quick little thing here.
Okay.
Because I finally found the graph really quickly. Can you see this?
Yeah, we can.
Okay, so this happens to have gold as well, but same thing. S&P 500 versus CPI, Consumer Price Index, since 1980. Again, it looks like CPI is this flat line on the bottom, and down here it doesn't look like much, but you get that compounding over 43 years, and this is what wealth inequality looks like. This is the people who are making 15K here are making 15K here. Even the median people making that 47 still making the same amount. But that top decile, especially that top 1%, let's stop kind of, or even a couple percentile, this is what their net worth looks like. This is the difference of that chart.
Right. Yeah. And it compounds the more wealthy you are more quickly. We mentioned the top decile, but certainly if you're in the top 1%, it looks even better. If you're in the top 0.1%, it looks even better. And then in the last conversation, we looked at the 0.0001%, and it looks even better there.
Yeah. Yeah. So I want you to kind of lay out again. So maybe it's like a how we got here kind of thing, and then why you think that'll continue.
Right. So the way I kind of see it is, we had a period where wealth inequality was actually becoming more fair, or lessening, essentially.
Mm-hmm.
And that was probably the period of post World War II until around the 80s, right? If we can put that into play succinctly. And that was a period where essentially you did have higher taxation. You had a higher amount of taxes being paid by corporations. You had a higher amount of taxes on a percentage basis being paid by the wealthy. The marginal income tax rates were higher around then, and so on. So that could be part of it.
Mm-hmm.
At the same time, I also think that was a period of very strong industrialization and modernization for the
Yeah.
economy, meaning there was a lot to go around, right? There just
Yeah.
so many things were firing on all cylinders that there was so much gravy, right? That everybody could enjoy the benefit of, moving from pre-industrial to industrial. And the economy benefited from that standpoint. And like I said, there wasn't so much pressure on wages to basically extract efficiency out of employees. It was more about, hey, we can get a 10x gain from going from, non-assembly line to assembly line. Let's all do this and benefit.
Yeah.
And I think that understanding allowed wages to increase at the same time.
I think we also saw uh that again, that era as you describe it, more people moving to suburbs. We had kind of more homeownership as a actually like that's kind of the origin. What we think is that like American dream idea, that people started buying homes. I don't know, have any good research like what the mentality at the time was. Like there wasn't as like, should they stay in the city or should they move to a suburb? Like should they buy the home? Like that create a situation where a lot of the population was becoming asset owners, and they were kind of benefiting from that. I would also say that, like you said, the less of a drive for companies to be as efficient as possible. And so there was a better relationship between kind of capital and labor. And so we saw like that. This was also like the area of like pensions were a big thing.
Mm-hmm.
And so there was a little bit more loyalty on both sides. There's both an incentive for employees to stick around and incentive for companies to make sure that they thrived by sticking around.
Yeah. You touched on this as well, but yeah, I think unions were probably bigger, in that generation,
Yeah.
or at least they had more bargaining power than they likely do today. I I think that there's this notion of moving, if you're a business moving into an untapped territory, it's known as like a greenfield market, meaning
Mhm.
there's so much room for expansion that you don't need to be so opportunistic, meaning there's just so much to go around.
Yeah.
Everybody can benefit by just engaging, in the enterprise. And that's how I kind of see it in the 1950s, meaning you could see 10x gains from putting in a supply chain that you don't need to worry about the small increase on that you're paying for labor each year. There's
Yeah.
plenty to go around. And we're not competing on a global scale either, right?
That's
So
true. Yeah.
a lot of economies at post World War II globally were devastated, right, because of all that happened in Europe and in Asia and whatnot. And the U.S. was, like the one of the few the only superpower that
Yeah.
was able to survive that and not be completely demolished from an infrastructure standpoint, from just an economy standpoint, meaning we were in a unique position to thrive from a lot of the mess that was created around the globe and
Yeah.
capitalize on it. And we certainly did. And it was a period where, again, there was enough to go around that wages could go up at the same time and the economy could increase at a pretty good clip. And all was kind of fine and dandy for a good 30, 40 years.
Okay. So I have a guess in the back of my mind. But I want you to get like, what changed?
I think a couple things changed. Okay, so have you heard of the Powell memo?
No, no.
Okay, so let's pull up some things because I don't want to stretch too far beyond my
Okay.
understanding. But
So one thing I remember I have heard is kind of the Cold War ended. Like the Cold War created this like insular economy, like and like you said, like the U.S. wasn't affected by World War II as much, and so we got to thrive. But also because of the Cold War, like there wasn't a globalization. Like, there wasn't really the opportunity to outsource jobs, kind of thing. So that was one thing I have heard where there was a different mentality in that. But once the Berlin Wall fell and like opportunities open up everywhere, we start to see almost like a like a trying to think of the scientific term was like a leveling, where it's like different U.S. influences spread around the world, but also different global influences came to the U.S. Like trying to reach like an equilibrium almost. And I'm almost wondering if that time, that post World War II, probably like 1989, I guess, but is that the anomaly?
I think that's it, headed in the right direction. I think there's a couple of things. I'll get back to the Powell stuff in a little bit, but I think globalization had a lot to do with it, right? Because you can imagine, for example, in the early 80s, U.S. auto manufacturers were doing great. Detroit was doing great. All of these different areas were doing great. But then came fierce competition overseas, where you had other economies like Japan and other parts of Europe putting out, for example, in this situation, automobiles that are more efficient, that are cheaper, that are built with less mechanical issues. A lot of the things that were concerning the manufacturing industry in the US, they were doing better, right? And that was putting price pressure on our vehicles, which starts to put price pressure on labor, right? Especially if those economies are building these vehicles with a lower cost of labor, then we have to also kind of make that up. So I think the shift towards globalization has one important peg, in this stool.
Okay.
The other one I was going to mention is, let me share the screen again. We talk about this notion of the pendulum kind of swinging, and how that affects policy changes over longer term. So I think part of the policy shift in the late 70s was that perhaps labor had too much power. Perhaps there was the marginal tax rate on the rich was too high. Perhaps there were too many constraints for economic growth, and corporations were restricted too much by regulation.
Okay.
So the Powell memo was basically a memorandum written by a corporate lawyer that detailed how there was an attack on American free enterprise, meaning all of these concerns were patent in his mind, and he was advocating for change. So this was picked up by Nixon, and Nixon ended up appointing him to the Supreme Court. And this led to a lot of changes in terms of what happened with critical cases within the court system, Supreme Court in general, that may have shifted the balance from certain key areas. For example, preceding Citizens United was a court case where Powell was a deciding vote on, which shifted the balance towards allowing, or which was basically one of the areas that led to the downfall of Citizens United decades later, right? So basically this was setting the stage for that shift in policy that we've seen over the coming decades. And then at the same time, we see the lowering of the marginal tax rates that I had mentioned, at the higher levels. Let me just kind of throw that into the mix here. Or before I sink that or move on from this, I'll just read the conclusion. I haven't read this yet, so we're going to read it together.
In real time.
Okay, so the Powell memo played a pivotal role in reshaping the relationship between American business and society, advocating for a proactive and strategic defense of the free enterprise system. It prompted businesses to engage more deeply in education, policy, and legal areas, right? And again, Powell ended up being on the Supreme Court as a deciding factor for many of the cases that ended up leaning towards a more corporatist standpoint. So it's something that I think did help shift the pendulum in the other direction. Let's throw in capital gains taxes and highest marginal income tax rates over time. Give me a table. Okay, let's see if this gets us what we're kind of jumping at on the tax side.
Podcasting.
Yeah.
Our viewers get to watch you use GPT, and our listeners get to hear you read something off the screen.
Right. Well, hopefully this is enough to be helpful in this discussion. But by the way, this is the new GPT-01 preview. I don't know if you've heard about that, but it does reasoning now, so maybe it's a little better at things. Okay, so what we're seeing here is the top marginal tax rate.
Back in 1913.
Yeah. And the maximum long-term capital gains rate.
7% to 77.
Yeah.
I mean, when you talk about the pendulum swinging, that's
right. So you can see the top marginal tax rate. Well, they just started in. I think they just implemented the income tax in the early 1900s. Yeah. So, but they quickly jumped it up to 77% in 1918, and it stayed in the 70s to 90s all the way until 1980, 81. Yeah. And then in 1982, the marginal tax rate was slashed to 50%, the highest one, and then down to 38.5, and it's been around that range since. So you can see that pendulum shifting in the late 80s.
This is the top marginal rate. So this is affecting that top decile, not affecting the median household income. Median household income.
Yeah. Time. So the highest rate that the rich pay on their income basically went from around 70% down to like 40%. In this transition period from late 70s to early 80s. And then the capital gains rate, the rate that the wealthy and investors pay on gains of or appreciation of assets, well, that rate started off in the 25% range, in the 40s.
Yeah.
And by 1969, it was 1978, it was 28%. And by 1980, it got slashed to 20%.
Yeah.
Again, we should also mention that this is on realized gains. So unrealized gains are still taxed at zero. Yeah. So that's another kind of loophole that's always kind of been there. But yeah, so you had this shift in the pendulum on the tax rates that the rich are paying. And then you had a corporatist Supreme Court that's advocating for more policies in favor of corporations, or not legislation. Sorry, I'm not. Jurisprudence, I guess, in favor of corporations, and then obviously the legislation and tax policies are also favoring the wealthy. So yeah, you had the shift, and then you had the globalization crunch, right? Over the next generation, the shift from being not entirely globalized to being far more globalized.
Yeah.
And now over the last 40 years, you had this hyper competitive landscape that is trying to basically extract every little penny out of every, little source to drive down, prices down to their marginal costs, right? You had the commoditization of many goods beyond basic commodities over the last 30, 40 years.
I think your auto example is great, where for the benefit of kind of both the company and the consumer, they're trying to bring prices / value of cars down. So or the value of cars up, which is either higher cost, or the prices down to be competitive with overseas cars. Mm-hmm. And kind of like, to get that squeeze, you got to be as efficient as possible, and labor cost was one of those kind of things that get squeezed.
Yeah, you got to squeeze everything if you want to be globally competitive. And if you're trying to maximize shareholder value, you have to, right? By mandate
Yeah.
of the business. And what that
Yeah.
effectively means is every input into the business needs to be priced as cheaply as possible so that the output can be priced as cheaply as possible.
I don't like it when you're convincing me of something I was ready to argue against. Okay, so I agree. Like globalization is one big factor. I think the taxes is a big factor, and like you said, like that kind of the stool of uh, favors towards corporate policies, um, and like the first question that came to mind was like, is wealth inequality better or worse now than 200 years ago, 500 years ago? Like I'm trying
Yeah.
to kind of think about that because wouldn't surprise me if wealth inequality is actually better now than it was 200 years ago, where it's like
Yeah.
90% literally have nothing. Like there's no middle class. 90% has
Yeah.
nothing, and 10% has everything, kind of thing.
No, that's certainly true. So, okay, so
So,
the other sideline story is a lot has changed. For example, consumer prices are way down for a lot of
yeah,
goods, compared to what it was in the 1980 or even the very longer history.
yeah.
Obviously, technological improvements, life expectancy.
Life expectancy is
We've
up,
mentioned this before.
literacy is up, child
Literacy,
mortality is way down,
poverty in general,
poverty,
right, is
yeah,
just way
poverty's
down,
down,
right? So you had a
hunger is way
bimodal
down.
distribution of income, like you said, hundreds of years ago. You're
Yeah,
either extremely wealthy or you have nothing, like
yeah.
literally nothing. So yeah, a lot of that has changed. So
Okay.
certainly there is now a middle class compared to the very longer term history. And the middle class is probably better off in many circumstances compared to even 1980,
Yeah.
in terms of life expectancy, in terms of the drop in consumer prices. But there are other things that are concerning, the fact that real wages haven't increased and the fact that um, cost of living in certain key areas have dramatically increased.
Okay. So my main counters that I was coming in here ready with. Okay. One is things like the ATM and horses versus cars at the turn of the century, and this idea that so many predictions of the world's going to hell, like things like we're going to put truck drivers drivers out of work. It's like it's going to be this driverless cars are putting truck drivers out of work, and all of those have always been pessimistic, and we've always come out the other side better. That is, it's driven up the value of the skills by workers, and there is some retraining, and some people are impacted significantly temporarily.
Mm-hmm.
And for some, if they're like depending on where they are in their life, it could be kind of permanently for them. But as a society, I think we consistently come out better than this. The second big counter I had
Yeah.
was I do think there's a general better education, especially among the US population, that they are participating in the stock ownership sooner and at smaller levels. And I think the lower income deciles, maybe even like the second or third and on up, I think they do have better stock ownership than they did 2 generations ago. Where I think they went from I work to pay my bills and my pension takes care of my retirement. We got to like, oh, the pensions go away as 401ks increase. So some workers were choosing to do the 401k. Others like, well, no, I'll be fine. And then they like, oh, they get to the end, they have like, oh, I guess it's just Social Security. I think there's a better, consistent education across the population that workers are investing more, and they are going to benefit from that equity growth beyond just uh, um, beyond just kind of the flat wages. And so
Yeah.
like that might mean like they're still not growing as much as the top because they're going to get the same compounding. But I think that wealth and incomes across the distribution will outpace inflation over the next couple generations, because I think there's going to be some small stock ownership level. I mean, like those are the two things that I was ready to come here with. I think that employees are getting better about trying to get participation of equity ownership when they can. Again, I might be biased there because my clients who work in tech do get equity compensation, but I can see more small businesses, especially with change in healthcare laws, that we haven't had enough time to see the impact of that. But again, I think that same idea of owning the small business is that ownership. It kind of, from an economic perspective, works the same as owning the stocks. And so I'm going to be extra optimistic. I do think that equity ownership will increase across those lower deciles, and they will participate some and at least outpace inflation. I don't know if this will like fix wealth inequality. Like I don't, that might be too much, but I do think incomes will outpace inflation.
Okay, so here's why I think this is happening, right? And I think that this will tie into a refutation a little bit. So what we've seen over the past 40 or so years is the commoditization of everything, essentially.
Mm-hmm.
Everything has been, or many things have been driven down to their absolute minimum cost. And, you know, that's been very beneficial from many different standpoints. But essentially, we've gotten so efficient at producing corn and producing agricultural inputs and producing meat and, you know, this, all of the factories producing consumer goods.
Mm-hmm.
What I think has also happened is employment has become commoditized.
My counter would be, I think that we will see a larger service industry. I think that there'll still be a demand for like skills that, because there's a human relationship and a psychological aspect that there'll still be that demand of. There'll still be a demand for physical trainers, even though the weights and the knowledge is commoditized down to zero. Like I think that there's still that relationship aspect that will still drive a lot of things like that.
Here's a distinction. So what I really want to hone in on that I'm saying is commoditized is wages, employment from wages, right? So you can get employment from two sources. You can get employment from the wages, like the W-2 income,
Mm-hmm.
or you can get employment from wages plus some sort of equity compensation, whether it's ownership of a company, whether it's stock options, whether it's you know, some sort of commission structure that lets you benefit in the growth of the company. So I think if you're getting employment from just wages alone, I don't think you'll see any increase going forward. However, if there is some sort of equity compensation, whether it comes from the employer themselves, or you take your wages, like you said, and you invest in your future by buying assets like stock, either through your retirement plan or otherwise, yes, at that point, you could potentially see some participation in wage growth or income growth, that is, on a real basis. But the part that's from wages, I don't think that's going to grow. And here's why, even in the service industry. It's because the notion of commoditization is there's basically a large supply of equally swappable items in a marketplace, right? And we've pretty much created that for employment as well. For example, your situation where you have a personal trainer, right?
Mm-hmm.
there's a marketplace for personal trainers, and they're all competing on the personal trainer marketplace website or whatever they end up using, right? And they're all trying to out whatever each other. Now, to the standpoint, to the point where that personal trainer acts like a business owner and tries to create alpha in some way, trying to outsmart the others, they will benefit, from doing that. But that's because they're acting more like a business owner. If they're being hired to just have a wage and have no upside potential beyond just the wage, whatever they get paid, then I don't see that changing. I see that being driven down to its marginal cost. And I see that employment notion basically stratified across all employment situations that rely on wages.
So now I'm trying to think of the impact of globalization again, where like what jobs can be done in a different location and which ones are, it's almost like an illiquidity premium to a wage.
Yeah,
if that makes sense. It's like this job, maybe collecting garbage, like again, that might be a bad example because I can see that staying commoditized, but like because there's probably more people who would sign up for that job than the job needs or something like that. And it's also like good training means like you can kind of take any worker to get there. But so I'm trying to think of like other location specific jobs that could not be globalized. I don't want to say outsourced, but the idea of we is there like a location specific premium to this particular job?
Right. Yeah. So let me share what the GPT says on the difference between a commodity and something that's differentiated, right? And see if that can apply to um, employment. Okay. So let's zero in on this highlighted section here. Again, I'm going to read that.
Okay.
Essentially, commodities are things that are standardized, right, with minimal differentiation.
Yeah.
So the way I see employment now is we have job descriptions across these various companies. They're quite similar. And if you're an employer looking for this type of role, well, you're going to get hundreds of applicants who have done exactly this type of thing, right?
Yeah.
And there's a marketplace for how much this type of thing gets paid. And your job is to pay that much plus $1, right?
So
And
going back to like fundamental definition, we guess like corn or gold or copper or silver, like the actual old fashioned commodities that we think of. It's I don't care who produces the gold. The gold itself is the same.
right.
The corn itself is the same.
Right.
So I don't care who I buy it from. Whoever's going to have the lower price on the corn, that's who I'll buy it from. Whoever has the lower price on the copper, that's who I'll buy it from. Because the thing is the same.
Exactly. Yeah. And, for all the roles for a big multinational organization, every single role has a distinct set of standardization surrounding what's required for that role, such that there are a huge marketplace of individuals who meet those qualifications, right? And if you're an individual who meets those qualifications, your job is to get the most amount of income for that qualification. However, if all the jobs are competing to offer the lowest amount and all the people who are trying to get the jobs are trying to get the highest amount, they're going to meet in the middle, essentially. That's how commodities work.
So the reason I still think of the service side of it is not quite commoditized is because I think that personalities matter. Like you could say I can go to a dentist or I can go to a different dentist and their education's the same, their technical skills the same, but whoever has the better bedside manner among the dentists, I'm more likely to go to that dentist. And I think that will play out and layer within the service industries enough that yes, some dentists get the commoditized wage, but some have the like personality premium that they can differentiate. And I think that this does play out enough across enough skills as it's an I do think it's again more service oriented, but it's the psychology and the personalities and the relationship aspect I think is going to make a difference. It's a different skill set, but it's not the job itself that I guess if you do just the job, I think that will probably be the lowest common denominator of the wage. That part might be commoditized, but you're doing the job plus making people happy.
Here's where we have to be careful, though. That in that dentist example, is that dentist an owner or an employee of a practice where the owner is somebody else, right? That's a big distinction. In the examples I'm trying to relate, these are non-owners. They don't have any benefit from the upside of the business beyond the wage.
I think this would actually be closer to like your commission example.
Well, okay, so in those cases, then you can benefit, right? Or you can become a partner of the dentist organization, right? Or you can start your own practice.
Yeah.
So, and let me share the differentiated products vantage point. So differentiated products are unique, have unique features, right? The dentist who does a little bit, who smiles more, right? Or who's more friendly.
That's the quality, the quality.
Yeah, but focus on quality, right? And you can command higher prices, right? That you can differentiate from that standpoint. However, I still posit that if you're an employee, it's going to be very hard to extract more value than you are worth. For example, you're going to be compared against other smiling employees. And yes, you'll get paid more, but not more than more smiling employees should get paid.
Okay.
Why would that?
If nothing else, like, there will, and this might be a labor negotiation thing, but like, if more people are making appointments with this dentist and not the dentist one share over who works for the same firm, that one dentist will be compensated more.
Again, is that dentist an owner or not? We got to keep that clear.
And that's why I say I think it might be it might be like some kind of commission structure, or might have to have some kind of labor negotiation.
Yeah.
But I think there's more awareness of the value of their skills.
Yeah.
That they can like see, I see more patients than this other dentist.
Yeah.
I should expect to be compensated more than the other dentist.
Right. Yeah. And what I'm saying is you'll get compensated for that exact amount of value that you add plus $1, but no more than that. That's what I'm trying to say. Right. Any extra value beyond that will go to the owners of the business. Now, to the extent that that dentist is incentivized to be an owner, then yes, that dentist will receive a higher than real compensation for that. Right.
Okay. So now it kind of gets to, should that dentist leave that practice and start their own kind of thing?
Right. Yeah, and that's a distinction.
I think that's probably the crux of my argument is like, it is risky, and there's reasons for that superior dentist to want to stay because it makes their life easier.
Mm-hmm.
And it's also like the owner's perspective to compensate that dentist enough that they won't want to leave and start their own practice.
Yeah.
So it's like there is some middle ground where I don't think employers are going to try to extract where the only option is you stay here and you get this or you leave. I think that there will be some level in between where it actually makes financial sense for both the owner and that dentist.
Yeah, so they say, for example,
that's an awareness of skills. That's like, yes, I don't want to have to go start my own firm, but that's my only leverage to see my income grow and get some portion of that equity, then they'll go do it. But and it makes sense for the owner to not want to see that dentist go, because we'll say that all the patients would follow that dentist kind of idea because they like the relationship, they like the service that they get. So the business owner would lose out if that dentist left. And so it makes sense that the owner would compensate that particular dentist above what just the flat wages would be. And that's why it might be some kind of negotiated compensation or like a commission structure or like some kind of percentage of profit. Like, so yes, it does kind of make them financially benefiting from that.
Yeah.
But they're not an owner of the business.
Well, so
and I think this will play out across a lot of things where it will make sense for the owner to reward those employees who are more productive than the baseline wage to keep them than it is to see them leave. And I think that we've seen enough where companies have seen employees leave, they go to another company, they get a raise because their skills are there. They'll even go back to the first company, get another raise. I do think that managers and employers will do a better job of trying to just increase that so that there's less of that switching costs.
Well, I think it ties into two themes that I want to bring up. What I'm trying to say is not that employees can't get a real wage that increases beyond the rate of inflation. I'm saying employees who solely rely on income from a W-2 that has no tie to the compensation of the business or the performance of the business, they're going to be stuck with a wage that doesn't increase beyond the level of inflation. And I say that because, yes, there are ways to encourage employees to think like business owners, and good businesses realize that, right?
And I think we'll see more society do that.
Well, and here's the second theme I want to bring up. We've been seeing less of that, unfortunately. For example, we've been seeing less loyalty over the course of the last 30, 40 years, not more loyalty. In fact, it's far more advantageous to switch jobs, like you just said, every couple of years to get that boost, because companies are trying to keep their costs as low as possible. And they realize, I think there's a behavioral reason for this. People are less likely to shift than shift, and they can take advantage of that. And I think that does tie into why you do have this switching around every couple of years as the more optimal strategy than remaining loyal to a company that can see you're adding value.
So I guess I'm saying this is it's a prisoner's dilemma where they can see each other and talk to each other kind of thing. It's like, we know this has happened. We know why you're leaving because we didn't reward you enough. And so I do think that the lack of employer loyalty, I think that came second. I think the employers and owners started driving down the efficiency, and they pushed. They went to 401ks instead of pensions. They started pushing employees out, and they will realize that they can benefit more because the employer doesn't have to pay from here to here because there is a benefit to the employee for staying. There's not a switching cost on the employees, but they can pay them from here to here, and both sides benefit better.
Here's my take. In this scenario that's already played out over the last 40 years, the employers have already benefited. They've taken all the value. And employees have taken zero. So why would they want to change? Maybe they could do better, right? But they're already doing great. They're already extracting all the value. What do they want? Value plus one?
Okay. Final thing. We're going to end this. The people who lived in the 70s and 80s are going to die. Yeah. And so everyone born after 2000 will get into those leadership decisions, and they'll decide, let's not be assholes. We don't need to extract everything. We can do really, really well and like just like increase like what I'm not saying we're gonna see wages grow at the same level as equities. That's not what I'm saying. I'm saying that it's mutually beneficial for them to see wages grow just a little bit more than inflation. Just a little bit.
I don't see it. I don't see why they would do that if they don't need
Because
to.
the decision makers lived through this. They've lived through these last two generations. And it's
Like for example, you remember the boomers in like the 60s and 70s. When we're in charge, we're going to change everything. It's going to be equality for all. Yeah, right.
I think boomers were a different thing. They're holding on to their house and driving house prices up because it's a NIMBY thing. Like they have their asset and they don't want a building next to like it's a different psychological thing. Okay, but and it's like I think it's gonna be a pendulum thing. Like it wouldn't surprise me if 2 generations from now there'll be a business owner like, you know what? I don't need to make increase wages. Like I'll go back to extracting full value or something like that because work has changed so much, or they go all automated or all AI or something like that we can't imagine right now.
Here's the problem I see. I don't think globalization is slowing down. Meaning, if you're playing more in real wages than you should be, you're not going to be able to compete on a global scale. And then you throw in all of the advancements with AI and automation into there, that's going to put even more pressure on everybody, to keep the wages lower. It's an uphill battle that you're fighting against, and I
think it's going to be on the service side and the relationship side. It's like I don't know when robots are going to replace my dentist. I don't know. Maybe, but probably eventually. But
they got the robot surgeries and the physician practices, right? And you got the AI diagnosing cancer at better rates than recently minted medical students. I did also, I don't know if you heard the news on the latest GPT-01, but apparently it's doing its PhD level now, right? In terms of
PhD level and everything.
Yeah. Math Olympiad level, and
maybe I'm too optimistic. My wife says I have rose-colored glasses. She jokes that I live in Aaron land. It must be nice there. Like maybe it's just, and maybe it's what the globalization thing is a probably a bigger factor, and it might be like what we see in some of the European democracies where they are using kind of UBI to make up for this, but I tend to be more positive. Like I think we'll get to a stage where I'm not saying that employers are not trying to grow for their profits. They can realize it's actually mutual beneficial. Like the training cost for a new employee will be greater than the increase they give the employee to stay. Like there's going to be selfish reasons for them to pay their employees more.
Okay, so a few things. I am still an optimist, and I'll tell you why in just a minute. But
okay. Let me just show. Go ahead.
let me just show one thing though. This is the equity ownership from 1983 to 2020. Even with all of our policy measures that we put into place, the top 10% still own more, and actually, there's been a smaller percentage of ownership by the bottom.
Okay, I would have been curious what it would look like from like 2010 to now, but that might be too small of a data set.
Yeah, but I think it's an uphill battle because again, you're having the top deciles still having those intrinsic advantages of having a lower tax rate and higher income and higher wealth accelerating and compounding. So now, again, I want to end optimistically, and I don't think wages on a real basis are going to increase, but my overall take is maybe they don't have to, right? Maybe productivity will end up increasing so much and the marginal cost of everything else will drop so much that it doesn't matter anymore, right? The fact that you could end up having such a large degree of wealth generated and split, even in the unequal fashion it is, such that the rising tide does lift all boats enough. Imagine AI is doing everything as we've talked
Okay.
about in previous episodes, and there's literally nothing left to do from an employment standpoint anyway. And who cares if the real wages aren't increasing, right?
Okay. I so that's almost easier for me to envision. I think this might be like a future UBI thing. Like it's almost like a Star Trek. Like
Yeah.
no one needs to work. We can make food, provide shelter. Like no one needs to work.
Yeah.
But if you want to, what do you want to do?
Yeah, and you can get paid the same amount you got paid on a real basis in 1980, but you're doing it for fun or because you enjoy it, not because you need it to put food on the table or to make sure your insurance is covered or you can afford that new car or whatever it happens to be. So that's my optimistic take on where this ends up, even if wages never increase $1 on a real basis from here.
Okay. Okay. You probably I'll sound less optimistic than I was at the beginning of the conversation, but I'm not quite going to quite say you convinced me.
I was going to say we can pick this up in like 5 years and see.
Oh, no. This is like we got to come back here 40 years from now.
Okay. In 2043, well,
There we
or
go.
2063. Sorry.
Oh, we'll do a one generation recap and then a second generation.
Okay, we can do that. Well, I'll add it to our respective calendars.
Okay. Well, thank you for the conversation today, Trishul.
Okay, good stuff, Aaron. Thanks for exploring this topic with me. And thanks everybody for listening and watching. If you're enjoying these conversations, do spread the word, and every like does help. So don't forget to do so. Thanks. Bye.
Bye. We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and has no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day.